Hello, everyone, and welcome to today's webinar, The Hidden Gaps in Your Fraud Strategy, How Fraudsters Are Outsmarting Your Loan Origination Defenses. My name is Matt Tepper, and I'm Vice President of Marketing here at GDS Link, and I'm thrilled to have all of you here with us today. Fraud prevention is not just an isolated challenge. It has a ripple effect across every facet of financial operations. Whether it's the main focus of your role or a factor that indirectly influences your team's success, fraud-related losses, compliance risk, and operational efficiencies ultimately impact your organization's bottom line. Addressing these vulnerabilities isn't just about security, it's about ensuring sustainable growth and performance. Understanding and addressing these challenges is essential for maintaining the integrity and success of your financial systems. Fraud, in all of its forms, is a persistent and evolving threat, impacting financial institutions at every stage of the lending process. From identity theft to transaction fraud, these schemes not only lead to direct financial losses, but also erode trust and increase operational costs. Among the most concerning trends in fraud today is synthetic identity fraud, which has rapidly become the fastest growing financial crime in the United States. Synthetic fraud typically comprises between 0.5% to 2% of the attempted account openings in unsecured lending portfolios, but represents nearly 10% or more of credit losses. But where does one start in identifying and mitigating fraud? If the fraudster's livelihood is based on staying one step ahead, how do you remain vigilant and agile? Should fraud screening happen upfront with identity verification? Should it be tied to credit risk modeling? Or should it be part of a broader strategy that validates account ownership before funding? Today, we'll explore how fraud, identity, and credit decisions intersect, and where institutions often miss key risk indicators. To help guide our discussion, I'm excited to introduce our esteemed speakers. First, we have Vivek Ahuja, Head of New Markets and Alliances at SentiLink. Vivek has played a pivotal role in expanding the company's market presence and establishing key partnerships since joining SentiLink in 2019. Welcome, Vivek.
Thanks for having me. Looking forward to today's chat.
Absolutely. And next we have Adam Taylor. Adam is Head of Customer Success here at GDS Link. Adam plays a crucial role in helping our clients assess their existing fraud prevention frameworks, diagnose inefficiencies, and pinpoint areas where their systems may be vulnerable. He works closely with our clients to help bridge these gaps using GDS Link's advanced decision solutions, ensuring they can proactively combat fraud while maintaining an optimal customer experience. Welcome, Adam.
Thanks, Matt. Excited for this discussion.
And before we dive in, a quick housekeeping note. There will be a live Q&A at the end of today's session, so please submit your questions through the Q&A or chat feature in your dashboard. Today's session is also being recorded, and you'll receive a replay as well as additional resources afterwards. So as we kind of step into today's discussion, Vivek, fraud isn't a new challenge, but fraudsters are constantly adapting. Many lenders are asking the same question: how do you stay ahead when fraudsters are constantly refining their methods? Synthetic fraud in particular has become a persistent threat, often slipping past traditional detection methods. We're seeing emerging schemes as well as sophisticated variations of I guess what we consider typical fraud schemes. Additionally, first-party synthetic fraud is on the rise, further complicating risk assessment. What are some of the biggest challenges institutions face in identifying synthetic fraud today? And as part of that, how have fraudsters leveraged tactics like credit washing to evolve their schemes?
Yeah, happy to address that a bit. I guess I'll add just a little bit of background on my end. I'm one of those folks in the industry that has worked in credit and fraud at a lender before, have sort of crossed over into the dark side, I would say, of sort of offering risk solutions. I say that a bit in jest. But I think one of the cool things about being able to sit in this part of the ecosystem is being able to see different types of fraud teams for different sorts of products, different customer acquisition strategies, different types of lending products as well. And so I think just sort of at a high level, this is always going to vary depending on the acquisition strategy and the product strategy. But to sort of drilling into, I think what prompted your question around sort of what's trending in synthetic and related frauds, just some of the more interesting stuff that we've seen in the past, I'd say 6 to 12 months. I do know that there's a few folks on the call that maybe in the auto lending space, maybe familiar with some of the you've seen some pretty sophisticated tied to organized criminal element auto lending related synthetic fraud in the South Florida area. If you Google it, you'll probably find a few articles starting to talk about that. Another one that we've seen that's been really interesting in the last year actually has to do with, I think, adaptation on the side of fraudsters is actually tied to sort of the overlap of third-party synthetic fraud and business account opening or business lending. There's some really interesting fraud MOs we've observed where it's very clearly like an organized criminal element behind it, where there's certain states where dormant business entities that have been aged for a long time, but are dormant. There's actually some very interesting fraud MOs we've seen where some of these fraudsters are taking over the identities of dormant businesses, so aged businesses that would pass most underwriting or lending or basic checks, but inserting third-party synthetic identities or totally fabricated identities as the principals or business owners for these dormant businesses. So quite a sophisticated sort of set of rings that we've seen attacking the small business account openings. I'd say that's pretty trending. We could touch on credit washing a bit as well. It's essentially false disputing of trade lines. I've seen that big uptick in the last year or two.
Yes, this kind of brings us to maybe our next question around just many lenders assume that they're covered because they're using multiple data vendors, but fraudsters have obviously, they're adapting to these tools and finding ways to manipulate them. Where do you see institutions kind of misplacing their trust in fraud prevention strategies, and what blind spots do you think this creates in their ability to detect fraud effectively?
Yeah. Yeah, a little bit related to what I was saying, but like in your last question, is like there's not, a singular thing you can say that's like a trend across, hey, there's a certain fraud MO that fraud teams aren't picking up on, or a very certain tactic, or a certain, operational process that a lot of folks uh, are not doing. But where would say that where we see teams, I wouldn't say struggle, but where they see bigger challenges, I think, in doing fraud risk management effectively is honestly when the fraud strategy isn't well suited or adapted to the acquisition strategy or the growth strategy at that lender or that bank or that credit union. So for example, I know that there's folks from credit unions on this call, right? Not adapting an indirect lending strategy for auto loans and not understanding that the fraud strategy for that has to look a little bit different than a strategy to get deposits in a digital account opening scenario to try to grow your member base with like sort of a deposits first acquisition strategy. So in that auto lending case, probably going to be more concerned about first party synthetic fraud, income and employment related fraud, thinking about that customer or fraudster experience in the dealership. Whereas for a digital account opening scenario where you may be offering referral bonuses to get people to sign up, understanding that fraud strategy is going to have to look a little bit more maybe tuned into identity theft or referral abuse related MOs. And so sort of over-indexing maybe on what you're used to instead of trying to adapt the strategy for what your acquisition strategy is going to be. That's where I really see teams maybe get out over their skis a little bit.
Yeah. Yeah. And just how you have to kind of form a strategy that's really built for your business, you also need to just make sure that it also kind of best fits for your individual teams too. Kind of building on that, Adam, another challenge that we often hear from lenders is that their fraud prevention strategies were built by previous teams. They're using tools or maybe vendors that they maybe no longer are the best fit for today's fraud landscape or maybe their business how it exists today. From a credit and decisioning policy perspective, how does this outdated approach leave lenders vulnerable, and where have you seen some of the bigger gaps existing today?
Yeah, I mean, turnover happens all the time. And when you inherit a strategy that someone else built, it takes a lot of time to dig into it, to understand it, to understand the purpose. What we see most often is the team, it doesn't take a step back, take a breath and holistically look at all the strategies. Like you have the acquisition strategy that turns into what our fraud strategy needs to be. And then feeds into the credit strategy. And so just taking the time to stop and think about that, what we've seen, at least in the past, is that people just add new data providers. They have something, some new development happened in their increase in fraud or charge-off, so they just add a new vendor, hoping that it'll fix it. But really just taking a step back, being able to look at the full strategy, and then attacking with purpose. Every type of lending is going to be a little different. As we mentioned, an auto lending or indirect lending strategy needs something different than something that's purely online, high volume, low dollar type interactions. So instead of just adding, we need to really look at the strategy and again bring purpose to what we're going to add to that strategy to rectify moving forward.
Yeah, and I know that in our pre-show discussions, we were kind of talking about the idea that fraudsters they don't just rely on brute force. They are exploiting gaps in workflows that institutions might not even realize exist. I guess Vivek, I'll go kind of go to you first. Can you share maybe some examples of how they're doing this, how they're kind of exploiting some of these gaps in workflows?
I could give you a pretty good example of like, I think this is, maybe some folks on the call have seen this, but in terms of, Adam had talked about, teams maybe sometimes just like layering on, data source after data source, or thinking about this as a pure sort of like rules and modeling sort of problem. I think when fraud fighting is done really well, it is like really multidisciplinary. And so I'll just give you an example of like a really common exploit that we see, which is, thinking about, let's say, an online application. Let's say you have an online application that has phones and emails, but you're not actually doing like essentially sort of a 2FA or a harder validation on the email or phone during the application process. A great example of an exploit would be, right, there's fraud MOs where all the information that's used in that sign up is sort of clean, like ties to the consumer, the phone, the email, all of that identity information is cohesive. But then not implementing something that validates that during the process results in, I call this like a contact change, like, or a post onboarding contact change MO, where it's like right after the sort of identity verification, onboarding, and credit risk assessment steps, there's a very, very shortly thereafter a change in the contact info for the phone and email. So that's like a great example of like, you talked about like a small exploit or like a hidden gap. Honestly, there are institutions, we've seen that, right, that aren't necessarily thinking about that, and then they get caught. Fraudsters will exploit that.
Nice. Thank you. Thank you for that. So now that we've covered the evolving nature of fraud and some of the blind spots that institutions may face, let's shift to how lenders can adjust their fraud prevention strategies. Fraud prevention is a key part of loan origination, but many institutions struggle to place fraud checks in the right parts of their workflows, as we just discussed. Some overcompensate for fraud spikes by adding maybe excessive friction, like unnecessary document verification, while others fail to apply controls where they're most effective. So Vivek, I'll start with you. Can you walk through the different checkpoints where fraud screening typically happens and what lenders should consider when determining this placement?
Yeah, sure. I'd be happy to speak to that. And yeah, I'm gonna sound like a broken record here. It does have to be adapted to the product or the acquisition strategy. And thinking about this as a multidisciplinary exercise, thinking about what's the expected loss if you have a false negative, what's the funnel dropout rate if you insert certain checks, what's the the expected loss if a consumer just drops out of your process, that's a false positive. Like, all of these things have to be weighed, and you also have to be thinking about the customer experience. But in terms of sort of a canonical application process, let's say for like an online application, generally speaking, where we see, where we typically, see application flows built out is, right, an upfront sort of application fraud scoring or risk assessment that's done early in the process that helps drive subsequent sort of steps in the decision tree of that application. Somewhere in the mid funnel, based on those sort of risk scores or an early risk assessment, like an identity verification related check. A lot of folks are familiar with that sort of identity and selfie experience, or an SSN verification, ECBSV, if you're familiar with that parlance, real-time SSN verification with the SSA, if that identity verification still needs to be, sort of validated. Post IDV, right, getting into some of those income and employment related checks that have to do with picking up on those types of fraud, and credit risk assessment also post IDV. And then lastly, post onboarding, being attuned to different sorts of contact change MOs that can happen related to the email and phone, sort of post onboarding. I think that's also a gap that teams sometimes don't think about. And lastly, I guess my disclaimer here is, if you have a chance to run experiments to understand this stuff better, running experiments and using your population and your data to help drive the strategy is also, right, super, good best practice to put in place.
Yeah. Yeah, and Adam, as we've discussed at institutions, they're certainly struggling with structuring their fraud decisioning strategies in a way that really kind of balances security with that operational efficiency. In many cases, as we kind of mentioned, sometimes they can be a little bit too rigid, creating that unnecessary friction, or maybe too lenient. Why do you think so many financial institutions ultimately leave fraud decisions to their credit risk teams, maybe without the right tools? And what are some of the maybe unintended consequences that come from this approach?
Yeah, I'd say first, quick comment. In your decisioning platform, you should have champion challenger to be able to test your new strategies. So as you're evolving and changing, the various strategies that you're attacking on the onboarding process or in your credit strategy, like, you should have the right tools that enable you to do that through, champion challenger or A/B testing. Just kind of being in this world, it just shocks me how many people don't have that opportunity. Like, they just don't have that option to try things out, try things new. But to get to your original question here, usually credit teams are larger, so they tend to be the fallback in especially the banking world. But I can give you an example of an experience we saw with a client where they were realizing identity theft, and they had a really clean front end, and they had a really knee-jerk reaction to it, to instantly put friction at the front of the funnel. And one thing we've noticed is that they don't, you need a step up, you need a gray area. Traditionally or in the past, there's been a lot of hard stops, hard yeses, hard nos, but what's that in between? And then what do you do when you get to that kind of gray area? What's your step up path? So I know you mentioned that a little earlier, but really trying to link all those things together, and having risk, having credit, like, they are two separate strategies. They work together, but they're two separate things. And again, I mentioned it at the top, holistically looking at your overall strategy in lending, how people are coming in, what types of people you want to block, and you want to progress through the stages. What's your gray area? What are you willing to risk? And then what paths are they going to take to step up to mitigate, the fraud that you need to block? All those things need to be assessed. They need to be, really thoroughly looked at in order to have a great execution of your overall strategy.
Yeah, and Vivek, as Adam kind of mentioned, obviously lenders often struggle just kind of ensuring that they have the right tools in place that are actually aligned with their actual risk exposure. It's obvious that even when institutions recognize the need for fraud prevention, not all the solutions are created equal. What's the most common misconception lenders have when evaluating their fraud prevention strategies, and how does this lead to blind spots in their risk management approach?
Yeah, so We already talked a bit, or I spoke a bit around the adaptation to the acquisition strategy or the growth strategy for the business and aligning that. But I think like double clicking a bit deeper, I'm just trying to many folks that are been in the lending space for a while. Like one of the worst things that can happen to a lender internally, what can create a lot of stress, right, is like maybe you have some age cohorts of loans, an age cohort, and your early stage, delinquency metrics that you track are off from expectations. I think many folks sort of on this call have probably been through that fire drill. You're trying to understand if there was a fraud risk issue that may have caused that. Was there something wrong with the credit modeling? Is there a macroeconomic impact around credit risk of consumers or businesses that you're starting to see in your early data? And so I think where teams I think tend to struggle there is in a couple areas. One, if they're not clearly setting expectations. The other is not having very clean credit and fraud models in this. And what I mean by that is like not doing a great job of classifying out credit losses that actually should be a form of fraud, and having that muddy the waters of how you're doing that type of sort of credit and fraud risk management interdisciplinary approach. And then I think sort of double clicking into that with different forms of fraud, not being super crisp on defining what it is they're actually trying to target, or the types of fraud MOs that are out there. So that's really where like a fraud investigations or operations team can help, obviously using classifiers like SentiLinks that would help target very specific types of fraud MOs that might have been in your application funnel. That can also help, right? And that's where I see teams, right? When you're in those fire drill or those chronic stress conditions, it's usually because what I've seen, you haven't been great at sort of classifying what you want up front, not understanding sort of what is credit, what is fraud loss.
Yeah, and I think to your point, obviously, as lenders are just attempting to adapt, it's obviously one thing to have the processes and the framework in place, but also having the right fraud data strategy really becomes critical, not just in detecting fraud, but in ensuring the team that folks' teams are equipped to act on it effectively. There's definitely not a one size fits all approach. Everyone needs to kind of determine what they're truly trying to prevent, how they're structuring their fraud defenses, whether they have the right expertise internally to make those informed decisions. I guess I'll go to you first, Adam, and then maybe you can follow up, Vivek. How should financial institutions think about defining and developing a fraud data strategy that aligns with their specific risk exposure? Are there any key considerations they should keep in mind when determining how they operationalize and truly weaponize these fraud prevention efforts?
Yeah, I mean the first strategy is your acquisition strategy that you need to look at. What are the type of products you're lending? What are the type of consumers or customers you're looking at to offer those acquisition strategies to, and you build from there. So is this a purely online type scenario? Then you're going to have a different strategy if you're going to see someone face to face, be able to talk to them, get other types of documentation and validation. So, I mean, you have to really be thoughtful on the whole journey a customer goes on to understand each of those core strategies. So your acquisition, your fraud, and your credit strategy.
Vivek, do you have anything else to
Yeah,
add
we
there?
guess just to riff on that a bit, some of the framework I think about, when you ask that question is just like, what's an internally fit strategy as well? So thinking about, so just to give you two very contrasting scenarios, right? Like, let's say I'm an unsecured lender, maybe a BNPL lender or some other like smaller dollar related lender, right? When you're thinking about the data that you're going to use for fraud or credit risk, right? Maybe these are small dollar loans, but you're trying to drive high repeat usage on those loans. Maybe the types of data that you buy or use in your modeling is different than a lender there where just to use the other extreme, mortgage or like really high dollar lending, right? Right, you're willing to pay more. You're willing to put the customer through more friction and pay for that because it makes sense, right? You're trying to balance the unit economics of the loans, thinking about the underwriting costs relative to the right, the conversion rates, the take up rates, right, later in the application process. So I think like honestly, like adapting to that, right? What's the internal fit for your product? That should also drive the types of right fraud or credit risk solutions or data that you're buying. And I think also thinking about like what your entire business's sort of resourcing you're going to put into it, right? You might have a lending strategy where it's about, right, you're building out a new product and you want to use a lot of first party data or your own data to help determine credit risk on a repeat customer. Well, you got to make sure you have data scientists that are also aligned with that strategy or credit risk modelers that are aligned with that. Because that can influence, right, how you think about, right, your vendor costs and your underwriting costs as well.
Yeah, yeah. I think you're hitting the nail on the head there. That folks just have to consistently kind of maintain a mantra of staying agile, constantly adapt because fraudsters are definitely constantly adapting, finding new ways to manipulate identity verification, exploit gaps and credit risk models, bypass the traditional fraud detection methods. Yeah, I think kind of the main theme here is that folks on the call is really just to stay vigilant. It also means understanding not where fraud is happening today, but also where it's going to head next. Vivek, can you share some real world examples on how fraud schemes are slipping through traditional fraud detection methods, and what folks should maybe be on the lookout for?
Yeah, so I'm going to be the guy that brings this up. I do think actually Gen AI is like pretty impactful here. Right, it's very buzzworthy here. I'm going to be the guy that puts that out there. I I do think anytime you have, right, this sort of these technology S curves or adoption curves of new technology, it's going to have, right, that's going to cause high adaptation on the part of the fraud side, the fraudster side of this ecosystem. The way I tend to think about this is maybe not the MOs, I guess from what I've observed, haven't been that different, right? The same, right? You have right synthetic fraud, identity theft, ATO, right? Scams, right? Like all the different fraud MOs that are out there haven't adapted in the way that you define them. But I would say the big shift I'm seeing is I would just say the ability to amplify those attacks, right? The ability to make those even better, make those more sophisticated, just increase the scale and the amplification of it is like, that's sort of my kind of overall take on sort of what's happening right now. I would say more on the digital or online account opening side is something that's fairly trending and sort of this macroeconomic sort of trend or impact that's I think worthy to note.
Yeah. Adam, I know that with the rise of as we were just talking about with the rise of AGI, there's definitely there's an increasing need for real-time monitoring. How do you think technology-driven fraud prevention tools can really kind of close the gap while maintaining that seamless experience for legitimate borrowers?
Yeah, I know we're definitely seeing an increase in machine learning or AI fraud models being developed by institutions, and so you're fighting fire with fire, and that's one of the best ways that you can implement it. It's seamless to the customer experience, but you get some data scientists in there, and it's purposely built for that type of lending, for your type of lending and your type of customers based on history, and it learns itself. So definitely seeing a jump in that more recently, and just again having a step approach. Adding there's new providers that come out here, but having the right step up in your fraud strategy, certainly helps. Instead of just kind of the yes no that we've seen traditionally in the past. Layering ones with what one type of identification that I like to use now is, instead of just looking at a phone number, just looking at an email, now we're looking at networks. Is this a burner phone? People are getting creative certainly increasing the volume of attacks, as he said, but all that kind of combined and can certainly help our borrowers, combat this new fraud.
And maybe as a follow up, and I'll let either one of you take this. Do you think that there is maybe a layer of fraud detection that institutions are maybe overly reliant on? And I guess what's the risk of that? How can they build maybe a more adaptive strategy?
Okay, go ahead.
I guess I mean what I would say to this is like right, I would love to be able to say that there's like a broad trend of like things that lenders or maybe not like a best practice that can be, or maybe a poor practice that can be dialed back, or a best practice that can be implemented across others. I guess maybe what I've seen in this vein is overall reliance on maybe one discipline of fraud fighting as a way to adapt to a problem or adapt to a new product. So just double clicking on that, right? Like over reliance on an ops heavy strategy where maybe you're building lots of queues, you're having lots of analysts look at that, and not balancing that with like sort of a product management oriented strategy, which might be looking at sort of balancing different steps in the funnel, thinking about the overall optimization of that problem. Let's call that maybe a product management or product analytics discipline. So maybe like that can be a blind spot for teams, right? If you're sort of over relying on one tool in that fraud fighting toolkit, and not thinking about not taking the time to think about holistically the other disciplines that you can use.
Mm-hmm. I mean, it ties well into the testing new data sources, like testing new strategies. I think people have a little hesitancy in introducing a new data provider to their strategies. And so, any way we can help to, champion challenger or introduce new data sources, do various studies on what you've already done, it can be very helpful moving forward and executing on updating your strategy.
Awesome. Thank you both. A lot of good insights today. We definitely kind of covered a lot. But now we certainly want to hear from our audience. We've already received a couple of questions through the Q&A panel in your Zoom console. Again, the Q&A button at the bottom of your console is where you can go and submit any questions for any three of us. But before we get into that, certainly want to just kind of make sure and make a note that here at GDS, we know that fighting fraud requires a multi-layered approach. That's why we've partnered with SentiLink to bring together best-in-class fraud detection with our powerful decisioning capabilities. By combining SentiLink's expertise in identifying synthetic and first-party fraud with GDS Link's flexible risk decisioning platform, we're helping lenders take a more proactive stance against fraud while optimizing their overall credit strategies. Together, we make it easier to spot and stop fraud in real time, reduce losses, and drive smarter lending decisions. And certainly just want to make sure to call out that if you're looking to learn more about how our solutions can work together, don't hesitate to reach out, and any of our teams would love to take the time to chat with you. So again, to kind of dive into some of the questions that we're receiving, the first one that's popped up here, what is the role of AI in fraud detection, and how reliable do we feel that it is? I'll let either one of y'all take a stab at this.
Sure. I mean, AI is only going to get bigger and bigger. And so it's tough to answer how reliable or how its efficacy is, because it's ever evolving, right? It's getting better and better every day. It's getting more realistic every day. But if you have the right methodology and you're training it, to learn and to update itself, those type of models, they're never going to be perfect. Or I guess never is a strong word in this day and age, but like they're getting really good. They're getting really, really good. And depending on what you're lending and your various other strategies, it can make a lot of sense to move quickly and have one of these models inserted in your overall strategy. It's just one of those things that's moving so fast that, it's incredible. So
Yeah. I guess, my answer to this question around reliability of AI, I guess it depends on how you're using it within your organization, right? There's this idea of like agentic AI or using, right, these agents to go, for lack of a better term, complete very mundane or boring or operationally burdensome tasks. And right, if that doesn't get it right, right, the accuracy of right, how those sorts of solutions are implemented, right, like, how reliable do you need it to be? Right, does it need to be right 100% accurate? Like probably not. But when you're thinking about right an application of right, do I want to use like an AI model to make automated decisioning? No, right, that is something that needs to be taken, that's a more serious, right, thinking about, right, using AI in that sort of use case, right? Full disclosure, SentiLink, we're not an AI company, right? We use machine learning based models where you can explain the features that are underlying the models. You can explain what we're doing, right, how our scores are actually defining risk, and we have a lot of control over that. Whereas like leaving something that's sort of more difficult to explain or more difficult to explain internally or externally, like that, right? You're in the business of lending. You can't do that. You need to be able to explain your decisions. So I just maybe the upshot of my answer is, I guess it really depends on how you're using it within your fraud strategy.
Yeah, yeah, absolutely. I remember hearing that really the weight that you put on what AI is yielding for you is kind of how you value AI. So I think kind of to that point, kind of making sure you have checks and balances in place. That's making sure that it's still kind of pointing you in the right direction. So yeah, great thoughts there, guys. Next question, and Vivek, I think I might have you take this one. Are synthetic identities still the biggest fraud risk, or are there new threats that might be taking priority?
Uh, it really depends on the portfolio, the type of lending you're talking about. Right, we're not gonna go out here and say, right, synthetic, right, everybody's getting just absolutely crushed by synthetic identities, and right, that's the only thing that you really need to be worried about. It really does depend on the right, the application, the use case. Oftentimes identity theft is a bigger issue than synthetic fraud, and depending on the type of lending or types of accounts that are being opened. So yeah, I would say it's still like maybe a useful framework to think about is, I think it's a constant threat. I think it's like maybe less maybe a little bit less spiky if you're looking at sort of high scoring rates over time. I would suspect if you look at most lending portfolios, synthetic fraud rates maybe are a little bit more stable, or maybe not as spiky as, let's say, right. Abuse rings might tend to come in a larger scale automated fashion, where something like first party synthetic might be more of like a higher baseline level that's consistent. And so it's sort of constantly there. And I think maybe one of the other things is like, right, a lot of synthetic fraud does blur the line of like what is right. Teams have trouble with credit risk and frauds for certain types of synthetic fraud, particularly first party synthetic, right? And then when you are in sort of a macroeconomic environment where people are more challenged, you might see more of that type of synthetic fraud MO. And so it's just something to bear in mind, as just sort of a consistent threat.
Next question here for maybe for you, Adam, is how can these fraud prevention tools be integrated into existing decisioning workflows without slowing things down?
yeah, I mean, there's many tools in there that are frictionless. They're you don't really experience it as a consumer filling out an application or anything like that. And so there's plenty of options there, and we mentioned it before, where you can introduce new data. You can introduce new strategies, and like an 80-20 ratio, and give it a shot, and then slowly increase, those percentages. So having the right tools in place to enable you to do that is usually half the battle. We talk to too many people that just they can't try new things without a full production deployment. Yeah, and that's just, to me, it's unacceptable nowadays. You got to be able to test it. You got to be able to try it before you push all in on a new strategy.
Just had another question come in again on the Q&A button on your Zoom dashboard. If you'd like to submit any questions for our panel. Aside from AI, what are some up and coming fraud prevention tools you think will positively reinforce fraud prevention efforts? Guys stumped him. Well done.
I would actually say it's a really good question. Like, what might be upcoming that's actually going to help as a fraud fighting tool aside from AI?
One of the simpler things I know that I've started employing is just the basic passkey, like getting rid of passwords. That whole journey of getting rid of passwords for everything, will certainly help where they're doing more, biometric or, various other types as this standard that everyone uses moving forward. So, thank you to our, phone providers out there for kicking that off. But, we need to get rid of passwords as soon as possible.
Plus one, I think where my brain was going was sort of something in this security or authentication world where that like we often don't talk about, right, the security and authentication as a discipline, like intermingled with fraud, but actually that is something that is trending, right? Where you might start to see sort of maybe a more of a security related flavor start to become one of the tool, right? Sort of security tools or authentication tools becoming a bigger toolkit for fraud leaders. So yeah, Adam, I think you're spot on with that one.
All right. So in interest of time, I think this is going to be our last question. But again, do not hesitate to reach out to Adam, Vivek, or myself for any follow-up questions. How do credit risk teams balance fraud prevention with approving good customers? I guess that's pretty simplistic there. But yeah, what really any sort of best practices and really kind of weighing the fraud prevention with a good credit risk strategy.
Yeah. I mean, it's knowing both strategies is one, making them working together. But you don't want to have such an egregious, fraud prevention that you're leaving money at the door. So again, being able to test, being able to benchmark, being able to change and quickly adapt your fraud strategy that also informs your credit strategy, and vice versa. Like they work together. And you don't want to increase, one with too much friction that negatively impacts the other. Because you can do that, you can apply that to both. I'm going to require more financial documents from you in order to validate, your cash flow, or make you take a picture of yourself and a government ID in order to validate who you are. There's a whole spectrum of what you can do in those strategies. But you got to know both in order to make sure they're in lock with each other, and that they're a well-oiled machine.
All right. Again, want to thank everyone for their questions for today's session. And before we leave you today, we certainly want to highlight a few items. Certainly want to call out invite everyone to check out our Lending Link podcast, where we explore key trends shaping the financial services industry, including synthetic fraud prevention strategies, as well as risk decisioning. Obviously, you can check that out via Spotify, Apple Podcasts, or wherever you listen. Both SentiLink and GDS Link will be attending both CBA Live in Orlando on March 17th through the 19th, as well as FinTech Meetup next week in Las Vegas. I would certainly love to connect with any of you that might be attending either one of those shows. And finally, GDS Link has released a new ebook on synthetic fraud. It's available for download on our website and will be included in our follow-up communication. That does bring an end to today's today's discussion. Would like to thank Vivek and Adam for their insights and all of you for joining us today. Once again, a replay of today's webinar will be sent out along with some other additional resources, including a link to the fraud ebook I just cited. Again, if you have any follow-up questions, feel free to reach out. Otherwise, thank you again for joining us, and everyone have a great day.